And let's start with the China power crunch story. What is it alerting you to in terms of Chinese investing?
I think there's a couple of implications here. Firstly, if you look at what's caused this crunch, but industrial production has been stronger than expected. In the first half, it was running at 14%, exports very strong, infrastructure investment was solid. And so inventories have run down. And then I think the bigger objective is the government's decarbonisation push, and certainly we've seen several provinces exceed emission targets. Now, this has implications not just for coal and electricity, but also in terms of commodity prices. So you've seen these production cuts impacting steel, aluminium, copper, etc. And we think that has implications, particularly for inflation impacting some of the downstream sectors.
And certainly those big sort of infrastructure type materials will also be affected by what's happening in the property sector. Is property just becoming more and more of a no-go?
We've been cautious on property for some time now. I think the two key objectives, firstly, affordable housing, that's a long-term objective from Beijing, and secondly, deleveraging, and property is really in the eye of the storm there on both those fronts. So we think that the pricing controls will remain going forward, and we also think that the deleveraging focus will remain, particularly on the more highly leveraged developers. And there's actually a risk of further policy, such as a property tax. The local governments need to find alternative funding sources to land sales, and so property tax could come in as well. So we do think property is going to remain very challenging, but I think for investors, they need to think not just about property, but also the second round or second order impacts of a weaker property sector, such as the sectors that sell into the property sector.
Ramiz, I do want to understand, how much more pain is still to go as far as the uncertainty is concerned for the crackdown that we're seeing in China? Because, at the end of the day, if investors sense that, okay, we know how the regime is going to work, then there perhaps could be a buying opportunity. So I just want to get that sense on where we are directionally here.
So the sectors that the government is concerned about really, I think it's difficult to kind of bottom fish in those areas. So whether that's education, healthcare, and in the internet space, online gaming, for example, there is the risk of a regulatory cloud continuing. It's hard to know when we're done with respect to those sectors. But we do think there are areas that are less at risk, such as the Chinese consumer sector, consumer staples in particular. We also think there's policy support for sectors such as domestic travel. So those sectors we think are relatively more comfortable from our perspective.